big decision that you made. And then we'll talk about the second big decision that you made. And before we talk about it, I want to frame this up, and I want to see if you agree with the way I'm framing this. So you started your company, and your company has been profitable for decades, and you guys had $475 million of retained earnings. Those are the profits that you guys as a company collectively made, and you had that in liquid cash. You go out after 30 years of creating this treasure chest of cash. You go out, you buy Bitcoin, $475 million worth of Bitcoin. And for all intents and purposes, it's doubled in value within 6 weeks, 6 to 8 weeks or whatever it was. And so you've effectively walked through a time warp of value creation in, I don't know what percent that would be, but I would think it's less than 1% of the time that it took you to create it, and you doubled it. Is that how you see what has taken place since October or September or whatever it was when you first put on this position?
Yeah, I see that. Look, I think that we went through a transition in March where the cost of capital went from 5% to 15%. And a rational person has to say, looking forward, the cost of capital is 15%, and the currencies are being devalued at 15% a year. In the Western world, they're being devalued at a faster rate in the other parts of the world. That means cash is a liability, not an asset. And it means that every fiat instrument based on cash, stocks, bonds, and real estate are starting to look like they need to be discounted at 15% a year plus the risk premium. So, unless it's a monopoly, and there's really no such thing other than, U.S. sovereign debt, everything else has some amount of risk on it. And so you're talking about cost of capital that's looking like 18 to 20%. So we got to this point, and we looked at it, and we just said, well, we're going to have to do something to remain solvent, right? And if you're
from a perspective of keeping pace with your buying power, when you say the word solvent,
I guess you would say if you want to preserve shareholder value, you're going to have to do something different than hold cash on your balance sheet. The cash becomes a minus 15% liability per year, reasonably speaking. So let's talk about corporate treasury strategy. So we're in an environment now where it's reasonable to think that the hurdle rate is 15%. And the currency is going to devalue by 15% a year for the next 4 to 5 years. That's the best guess. It could get worse. It might be a little bit better, but once you crank that assumption in, then you have to say, is cash an asset or liability? Well, cash is a liability. If you want to preserve shareholder value, which is the same as preserving wealth, which is the same as preserving value, right? If you wish to store value, then at 15%, you're going to lose 75% of the value in 10 years. You're not going to be able to buy anything with it, any asset with it. You can't really focus on inflation rate. You got to focus upon the cost of capital. Now, if you look at stocks, bonds, and real estate, the issue is they've all got a yield on them, but the yield probably doesn't beat the risk premium, or probably isn't. I mean, the yield of the dividend, et cetera, yeah, you're getting 3% or 4% or whatever, but at the end of the day, the credit risk of holding a bond that yields 5%, is such that you're stripped down to 2% risk-free or so. And so you're still going to be looking at something which is 10 to 15% dilutive every year. So stocks, bonds, real estate, they're not going to hold value either. People, I think they delude themselves into thinking that they're safe in these things, but I think we're at the end of the road for stocks, bonds, and real estate because they've all been inflated to a max by the progression of the interest rate to zero and by the leveraging up of all the companies to put as much cheap debt as they could in order to get the most amount of leverage. And at this point, there's not any more leverage you can put on these things, and you can't put the interest rates below zero effectively. So a reasonable estimate is if you park $500 million in any of that stuff, you're still going to lose 10% to 15% a year. You're going to think maybe, these traders, they think, oh, I can take leverage and trade this and that, and I'm a stock picker, but at the end of the day, you're going to make as many mistakes as you make good guesses, and you're not going to outdo the money. Or the return on the money, which is going to be minus 15%. So you're probably staring at the same minus 15%. And you might actually get horrifically worse than that. I mean, right? There's worse results than losing 15% a year, right? If you invest in companies, they go insolvent. But the best result is you're just holding a market basket of assets that the Fed is going to buy. And as the Fed buys them, you've got that inflation.